Good evening to all present here today. Thank you for joining us this evening for the webinar. My name is Sudarshan, and I will be taking you through today's webinar. Over the past month, we have seen quite a few reforms and changes that have taken place in India, and quite a lot of them are setting up quite a strong and stable growth for the Indian economy in the future. We will be reviewing some of these changes in this webinar. To begin with, we will be looking at the Indian economy, we'll be looking at the global economy, and how these affect your finances and how you should be investing in such a scenario. We start off with the Indian economy as a whole. We received news of the ease of doing business rank that's conducted by the World Bank. India's position in the ease of doing business rank improved by 30 places. Earlier, it was at 130, now it's moved to about the 100th position in 2018. And this was announced by Finance Minister Arun Jaitley. Across most of the parameters that are used to assess the ease of doing business, India has progressed in almost all of them. There are a few areas where it has stepped back in a couple of places, but on the whole, the rank of India in terms of ease of doing business has improved. A lot of these is due to the reforms that were carried out over the past 1.5 years. Among the reforms, we've had the introduction of the bill that allows the liquidation of assets in case of non-performing assets. This came in the form of the Insolvency and Bankruptcy Code that was introduced earlier in 2017. The ease of doing business is not just about the ease with which you can start a business, but also the ease with which a business can be shut down and sold. The introduction of an insolvency bill greatly helped corporates with an option of an exit, and at the same time, an option for also the debtors, mainly the banks, for reducing their non-performing assets. Reforms were introduced in the form of tax payments as well. The demonetization move also had a motive of promoting digital transactions. Clearly, there is a push for a digital economy in India. While it is still a far cry from where it is right now, it is still a step in the positive direction. The payment of taxes has to be electronically is another push towards the same direction. Administrative measures have also been introduced to improve the taxes. Overall, transactions can also become much more smoother in India, and at the same time introduce the transparency required to reduce corruption. And as we had said before, the ease of doing business is not just the ease with which business can be started, but it can also be shut down. Towards contribution to the ease of starting a business, permanent account numbers and TAN numbers have a process has been introduced to merge these. The biggest beneficiaries of this will be the startups, and startups currently are one of the biggest employment generators in the country. We also had an announcement of 7 lakh crore stimulus package on October 25th. Out of the 7.6 lakh crores which was announced, 2.2 lakh crores was to be used in the recapitalization of banks. Remaining about 5.4 lakh crores, is to be used for the investment in infrastructure. The move to recapitalize banks can help the banks that are the biggest lenders to the economy in increasing the credit offtake. Earlier, when the Reserve Bank of India had lowered the interest rates, the amount with which this lowering of the interest rates was passed on to the end customers was minimal, or it was diminished because of the existence of non-performing assets in the banks. With the recapitalization, banks will have much more room to lower their interest rates and thereby increasing the credit offtake. But the more bigger move, we can see much more of an impact in the more short, medium term, is the investment in infrastructure. In a 2013 working paper by the National Institute of Public Finance and Policy, it was found that uh, the approximate capital multiplier, uh, capital expenditure multiplier, was to be 2.45. What this means is that if the government invests about 1 lakh crore, then it will have an impact of it will increase the GDP by about 2.45 lakh crores. Because of investment in infrastructure, there are a lot of industries that stand to benefit. To put it in the most simplest of terms, if the government wishes to construct a road, it is going to issue contracts to a road construction company, who in turn will issue contracts to the raw material suppliers. For example, those who supply asphalt, tar, and gravel, for example, and that in turn will increase the demand for laborers, thereby boosting employment. With the improvement in the road structure, the movement of goods will also become faster. All of these contribute by about 2.45 times to the uh, GDP growth of India. There was also concerns regarding how whether uh, the stimulus package will actually affect the fiscal deficit of India. Currently, India's fiscal deficit is expected to reach about 3 to 3.2%, but with the stimulus package, it's expected to rise to about 3.5%. The primary reason for this being that under the current accounting practice by the International Monetary Fund, uh, the credit that India will be accruing for the stimulus package is below the line and not part of the deficit. But however, for India's accounting standards, it will still be counted as a deficit. So what this means is that despite India taking in a stimulus package, the fiscal deficit of India will not be affected greatly, which in turn means that in the future uh, there is a lesser risk of devaluation of a rupee. Just why since the introduction of the stimulus package, we have seen the rupee value strengthen rather than decline. Moving on to the actual measurement of the performance of India in the last month, we saw that inflation has hovered around the 2.5 to 3.5% mark, as it has been in the last previous 2 months. The CPI stood at about 3.28%, whereas the inflation, as measured by WPI, hello, am I audible? Hello, am I audible? Okay, thank you very much. Now, as we now the inflation for India, the RBI would like the inflation for India to be at 4% plus or minus 2%. Now, looking at the inflation numbers to the left, the CPI as well as the WPI are completely within these limits. Now, although the inflation is on the lower side, the RBI may not be encouraged to lower the interest rates any lower. It will instead push the banks to lower the interest rates on their own. Looking at the PMI numbers, uh, the PMI as measured for the services, the manufacturing and composite are all in the positive. A reading of over 50 indicates an expansion in economic activity. The composite PMI has been positive for about 2 consecutive months, and ever since the introduction of the GST and the demonetization, the overall the composite as well as the services PMI are at a high. In fact, uh, the PMI as for the services is the highest since June 2017. And this indicates that the economy is slowly adapting to the new conditions under the GST. Additionally, we expect a further boost to the GST in this month, a further boost to the services sector this month because of an expected meeting tomorrow on the revisiting of the GST structure. About the items that are listed in the 28% slab are expected to be reduced in the meeting tomorrow. This primarily will aid the small industries and MSMEs basically. Now, the MSMEs contribute the largest percentage to the Indian economic activity. The review of the GST slabs tomorrow is likely to benefit the MSMEs, thereby further boosting the PMI for this month and the coming month. Manufacturing, on the other hand, has remained flat. We expect the manufacturing activity to pick up in the coming months, primarily due to the investment of the government in infrastructure and the ease with which the banks can roll out the credits. From India, we look at the European Union and the United Kingdom. Unlike India, the European Union has a much more dovish central bank. Currently, the interest rates maintained by the European Central Bank are at about 0%, which means that borrowing in the European Union is practically free. The inflation is the biggest concern for the European Union. They would prefer an inflation consistently at about 2%. However, this mark was not reached in the last couple of quarters. So the European Central Bank is not entirely encouraged to raise its interest rates at the moment. But the effect of the lower interest rates can be seen in the economic activity otherwise. As can be seen to the right of the screen, the PMI for composite manufacturing services are all at a high. Manufacturing PMI is at a 58.5, meaning it is continuing to expand at a much more rapid rate. But this, however, should be kept in mind that this is because of the lower interest rates maintained by the European Central Bank. The the Bank of England, which is equivalent of the RBI in the United Kingdom, has has an opportunity now to raise interest rates after since 2012. The inflation in UK stands at 3%. Now, this is due to a combination of factors, including the weakening of the pound since the Brexit and the increasing commodity values in the global markets. These factors, although are contributing to the UK's inflation, they, however, are not encouraging of the Europe of the Bank of England to raise the interest rates as quickly as possible. However, the Bank of England has said that it expects inflation to rise a bit more further before it can consider revising the interest rates. But overall, the economy of England and the EU is performing well. The unemployment rates are 7.5%, 4.3% for both the countries, for both the economies, which is a multi-year low since even before the Greek crisis. Another economy that is dealing with low interest rates is Japan. Last month, flash elections were conducted by the ruling Prime Minister Shinzo Abe. In a move that is quite similar to what Prime Minister Theresa May did in the 2 months earlier, Prime Minister Abe also dissolved his parliament and called for flash elections in the hope of getting the two-thirds majority in the parliament so that he can push for more aggressive measures. And in Sunday's elections, the Japanese Prime Minister did win the two-thirds majority in the lower house. So what we can expect from this is a much more aggressive uh, financial policies to be adopted by Japan, which basically means that Prime Minister Abe will be buying more credit and looking to lower the interest rates further from the negative interest rates that already it is. However, the Central Bank of Japan has said that it will maintain the short-term interest rates at minus 0.1% and target the 10-year at 0%. Basically, what this means is that the Japanese yen will be expected to become much more cheaper in the world market. And that is precisely what happened after the re-election of Prime Minister Abe with the two-thirds majority. Now, because of the much more aggressive measures that Prime Minister Abe is expected to take up, we can expect exports from Japan to pick up, inflation also to pick up. The Bank of Japan wants inflation to be at 2%, but currently it's only at 0.7%. Over the past year, the core inflation has not gone below the 0% mark, which is what the biggest calamity that Japan has been facing since the 1990s. Unemployment rate is low, wage growth is high, but we expect that the inflation will not reach the 2% mark that the Bank of Japan would like it to be. But however, in the coming quarters, we do expect the inflation to pick up with the weakening of the yen and increasing commodity prices globally. Moving on across the Pacific, recently, the United States President Donald Trump had nominated Jerome Powell to become the successor of Janet Yellen as the chair of the Federal Reserve. The current chair of the Federal Reserve, Janet Yellen's term expires in February, and she and her role has been marked by a recession which she pulled the United States out of, and maintaining rather low interest rates. And over the past couple of years, she has managed to raise the interest rates, thereby steering the economy into a much more stable position than what it was about 2 years ago. We don't expect much to change in terms of the policies that will be adopted by the US Federal Reserve, although the chair will be changing, because of the rather similar outlooks that both Jerome Powell as well as Janet Yellen maintain. The Federal Reserve is likely to raise interest rates in December and then twice once again next year. So during the periods of December and about 2 times next year, we can actually expect the rupee will weaken during these phases. But given that the Indian government is taking initiatives to boost the economy, we expect that this will only be a temporary blip, and we can expect the rupee to strengthen against the dollar in the coming months as well. But looking at the performance of the US economy, the jobs have been added in the previous month. About 261,000 jobs were added in the month of October, compared to the month of September, where it had lost about 33,000 jobs. Unemployment rate is low. Wage growth is 3.22%, and the core inflation is at 2.2%. All of these factors suggest that the Federal Reserve is all set to raise the interest rates in the next month. The economic activity, as measured by PMI, is positive across all sectors: manufacturing and services and composite. and this despite having an interest rate hike. This suggests that the US economy has finally found its ground. What we can expect from here on are reforms that will boost or bolster the growth further. The USA is the largest consumer in the world, and the largest exporter in the world is China. Specifically, the dominant economy of the Asia Pacific region. The Chinese economy is also taking on a lot of credit to boost its growth. Uh, in the last month, the yields of the Chinese bonds were down after a cash injection by the People's Bank of China. However, despite the despite the cash injection into the economy, there is reduced optimism due to the exceptionally high amount of debt that is already being added to the economy. The Central Bank of China notes that the corporate debt levels are quite high and the household debt is also rising too quickly, which basically means that China is taking on more debt than it could potentially handle. That continues to remain the biggest concern. However, in the previous meeting where the government of China had convened for an conference, uh, the president of China, Xi Jinping, had proposed to continue to boost economy through credit, but at the same time also looked into the prospect of lowering the credit intake into the economy to boost its credibility. But overall, the composite PMI, the manufacturing PMI and services PMI of China are all expanding. And if China grows, so does the rest of Southeast Asia. As can be seen in the PMI as measured by Southeast Asia, the Southeast Asian economies' manufacturing activity is picking up. So overall, if you look at the world over, we have seen the European Union area, the United States, India, Asia Pacific regions, that all are picking up. But this is primarily due to a credit-fueled growth. And one economy that can ride this growth primarily because of global trade is the Latin American economy. When the world economy grows, so does the demand for commodities. And when the commodity grows, so do the prices of it. Latin American economies depend primarily on the price of commodities. In the past month, we've seen composite PMI decline in Brazil. But however, manufacturing activities picked up, but services has also declined. Brazil was in a recession until 2016. It had expanded for the first time in the quarter that ended in March 2017. It has managed to have a positive growth, although marginally in the last couple of quarters. But it can only, however, we expect more reforms to be taking place in Brazil before it can resume its position as one of the fastest growing economies in the world. Overall, the Latin American economies are picking up pace. And with the commodity prices rising, we expect that the expansion to be much more brisk in the coming quarters and the coming months. Now, when we look at the commodities that primarily affect India, we first look at oil, because oil and gold are two of the biggest imports by India in terms of commodities. And over the past couple of months, we've seen oil prices rally from lows of about $47 in the beginning of September. Oil has rallied by more than $10 per barrel over the past couple of months. And this primarily is due to OPEC, namely by Saudi Arabia. OPEC had convened last year and agreed to reduce production to boost the oil prices. While oil prices did not appreciate as quickly as expected, over the last couple of months, we've seen it appreciate at a much faster rate. Oil prices have rallied to a two-year high because of the continued efforts by OPEC along with Russia to reduce production outputs. There is further risk of oil prices rallying because of political situations in Saudi Arabia. In Saudi Arabia, Prince Mohammed bin Salman, or shortly known as MBS, has taken up brisk measures to boost the oil-dependent economy away from oil dependency. Among the measures that has been taken by Saudi Arabia was to open up its economy to other forms of income other than oil. And recently, there was also an operation where almost 11 high-ranking officials from the royal family were arrested on allegations of corruption. How this affects the oil economy is that Saudi Arabia is the largest exporter of oil. And when there is a political unrest or politically uncertainty in the Saudi Arabian government, it may also have an effect on the oil production of the country due to potential instabilities that rise out of this. Which is why we also saw that the Brent oil had breached the $60 per barrel mark on 6th November. That's the first time it's breached the $60 barrel mark in 2 years. Looking at the second biggest commodity that India exports, which is gold. Although the Indian demand for gold has declined, physical gold in the last couple of months, gold prices still are holding steady for the last couple of months as well. Gold prices have reached a high in mid-September in early September due to the tensions rising from North Korea and the United States, which potentially could have resulted in a war. But however, since then, there wasn't much news that came from North Korea. So there was a perception of reduced risk, thereby strengthening dollar and weakening gold. But there has been tensions rising from the Middle East, which in turn means that gold prices may expect to rally. Further, in the last month, we had also seen Catalonia declaring independence from Spain. Now, with Catalonia declaring independence from Spain, you can see a bit of political uncertainty coming from the European Union. And with political uncertainty, there is also an economic uncertainty, which means that there will be a demand for gold. And due to these factors, we've had gold hovering around the $1,270 to $1,280 per troy ounce mark since the second half of October. Now, based on how the political uncertainties in the European Union and Saudi Arabia pan out, we can actually see the direction that the gold will take in the coming months. Now, how does what we discussed so far affect you? First of all, oil, which we discussed in the previous section, is rallying because of an event that's taking place in Saudi Arabia. Because of that uncertainty in Saudi Arabia, we can expect the price of the petrol and diesel to actually rise. And when the prices of diesel rise, the price of transporting the food from the farms in the villages to the city also rises, which in turn means that the food prices will rise. So we can expect an inflation much more than the 3.2% which we saw in October. Now, with the rising oil prices and India importing almost 82% of its fuel requirements, we can actually see the current account deficit of India widening. Now, with a much larger current account deficit, we can expect the Indian rupee to weaken because of the macroeconomic factors. Now, with the Indian rupee weakening, other goods that are imported will also turn much more costly. Because the economy of China is also performing well, the demand for commodity is increasing, which in turn means that other commodities such as copper will also will also have a lot more demand and rally. And with increase in the copper prices, uh, the import basket of uh, India's commodities will also expand, which will further contribute to India's current account deficit. Now, with regards to the factors that's been taken uh, that have taken place in the Indian economy in the last couple of months, the fiscal stimulus taken by the government of India, namely the bank recapitalization, will make access to loans much more easier. The RBI may not lower its interest rates, but we can expect the retail banks or the lenders directly to reduce the interest rates. Although the fiscal stimulus uh, will not affect uh, the fiscal deficit of India as per the IMF standards, it is still an additional debt. So we may see a slight effect on the Indian rupee on the downsides. So importing of goods will become slightly costlier. Now we look at how to arrive at a proper portfolio, namely the investment strategy. When the fiscal deficit, sorry, when the fiscal stimulus and when the ease of doing business ranks were announced, the Indian markets rallied, and this is a positive sentiment in the market, which means that the market expects much more growth to be coming because of these two. With the ease of doing business index, we can expect much more investments coming into India, and we can and with the fiscal stimulus, we can expect much more demand and manufacturing activity picking up in India. Both of these will contribute to the addition of the Indian economy's GDP. So we can expect that the Indian economy will pick up steam in the next couple of quarters, and this in turn will be reflected in the equity markets. And because of this, we are quite bullish on the Indian equity market, and it is best to hold equity for the longer duration. Because during shorter trades, you might miss out on the longer gains. There will still be a bit of volatility in the global markets, specifically if you look at oil. Now, with the rising price of oil, uh, rest of Asia, which imports its oil, will get affected. So there will be volatility with the rising oil prices. We can see the volatility in the Asian market specifically, and this to tide over this, it would be much better to invest in the longer duration rather than trade. Looking at bonds, we've seen that the government of India has introduced a fiscal stimulus primarily uh, driven by uh, debt. Now, because of the fiscal stimulus, we will see that the banks will be pushing interest rates lower, but the RBI may not necessarily do that because the RBI also factors in the macroeconomic factor, where we can see the rising commodity prices will have an inflation in India. And because of this, the RBI may not lower the interest rates in the coming months. So, with the lower prospect of an Indian, with the lower prospect of the interest rates coming down, medium-term bonds become much more attractive. So, in the portfolio, it will be best to have bonds with medium-term duration. Bonds will help stabilize the portfolio, but due to the volatility introduced by the equities. Now, as we had discussed in the commodity section, gold will there is still uncertainty uh, politically because of the tensions in the Middle East and the European Union. And in the next couple of months, we can see in which direction that these political uncertainties may go. But as long as there's an uncertainty, gold becomes a preferred instrument for hedging. So it is best to hold gold at about 5 to 10% in the portfolio uh, to stop the losses that you may make in equity because of the political uncertainties across the world. And with this, we reach the end of our webinar. Thank you very much for your participation. We are now open to questions. The fiscal stimulus. How long will the effect of government pouring money in banking sector do you think will last for? Um, this is a bit of I mean, this is a bit of a question that will take a bit more of time to assess because it's not yet, it cannot be seen reflected in the Indian economy yet. But the last time that the government did infuse such capital, we had about a 10,000 crore infusement that was supposed to happen this year. We have seen that because of this, we've seen that this recapitalization lasted for about 4 years. Now, with regards to the effect, it depends on a lot of factors that are also macroeconomic. So, as we had discussed, with the global economy picking up, we can see that inflationary pressures will be coming in the form of commodities. So we can expect that the government will continue to pour money into the banking sector for about for another 4 years. Do we have any more questions? No. Adding further to the previous question asked, the effects of the bank of the government pouring money into the bank can also be seen for a much more longer duration. So it so this is basically more of a long-term game more than anything else. In the immediate term, we will see credit become much more easier, gaining much more easier access. But it must also be kept in mind that with ease of credit, the effect or in which the credit is utilized is much more longer term. Like for example, with the bank being recapitalized, a company can borrow about 10,000 crores from a bank, and the company in turn can invest this 10,000 crores into projects which last over say for another about 7 or 8 years, for example. So the actual effect of the bank recapitalization uh, will last much longer than can actually be predicted. Do you have any more questions? All right. Thank you so much for your participation in today's webinar. We will be sharing the recording of this webinar with you in case you would like to view it again. Thank you so much. Have a nice evening.